There's a type of insurance policy that lets corporations write off tens of millions of dollars in taxes, insure themselves against their own risks, and legally move money almost tax-free. And until the 1980s, almost nobody outside of Fortune 500 boardrooms knew it existed. It's called captive insurance. And the reason you've probably never heard of it isn't that it's illegal, it's that the people who use it don't particularly want you asking why they can. Before we get into captives, let's make sure we're on the same page about how insurance normally works, because the twist only lands if the baseline is clear. Insurance at its core is a pooling mechanism. 1,000 people each pay a small premium into a shared pool. Most of them never file a claim, a few do. The pool covers the few because the many paid in. That's it. That's insurance. Now, what happens if instead of 1,000 strangers pooling risk together, it's just one company insuring itself? That's a captive. And it's not a loophole someone found in 2020. Captives have existed since the 1950s, when companies with unusual risks, think oil rigs or shipping fleets, found that commercial insurers either wouldn't cover them or wanted to charge absurd premiums for risks the insurer didn't understand as well as the company did. So these companies did something simple. They created their own insurance company, a subsidiary, one that exists to insure its own parent. Here's where it gets interesting. When a company pays premiums to a traditional insurer, say State Farm or Chubb, that premium is a straightforward deductible business expense, standard stuff. But when a company pays premiums to its own captive insurance subsidiary, something different happens. That premium is still typically deductible as a business expense on the parent company's side. Meanwhile, the captive, the insurance company receiving that premium, can often be structured to be taxed far more favorably, sometimes in a different jurisdiction entirely: Vermont, Bermuda, the Cayman Islands. These are real, well-documented captive insurance domiciles, meaning literally places companies charter these subsidiaries because the regulatory and tax environment is built for it. Vermont alone has licensed over 1,000 captives since the 1980s. This isn't fringe, it's an entire legal industry with its own regulators, conferences, and trade associations. Now, there's a specific structure worth naming because it's the one that's expanded far beyond big corporations, the 831B captive, named after the tax code section that created it. An 831B captive lets a small insurance company elect to be taxed only on its investment income, not on the premiums it collects, as long as those premiums stay under a certain threshold, which is roughly $2.8 million a year as of recent tax years. Congress created this provision specifically to help small insurance companies get off the ground. But here's the catch. Nothing in the law says the captive has to be small. It just says the premium has to be small, which means a small or mid-sized business owner, not just a Fortune 500 company, can set up their own 831B captive, insure their own business against risks their commercial policy doesn't cover, pay premiums into it, and potentially shelter that income in a very tax-advantaged structure. And this is exactly where things get contentious, because the IRS has taken notice. Since around 2015, the IRS has repeatedly listed certain abusive micro-captive arrangements as a transaction of interest, and later added some structures to its list of listed transactions, meaning the IRS considers certain 831B setups to be aggressive tax shelters dressed up as insurance rather than genuine risk management. The difference the IRS is looking for is simple to state, hard to prove. Is this captive actually insuring a real priced arm's-length risk? Or is it just a vehicle to move money out of a business income tax-free with insurance as the label? Some business owners have gotten this right, worked with legitimate actuaries, priced real risks their commercial insurance didn't cover, and built captives that have survived IRS audits. Others have gotten it very wrong and ended up in tax court, with the IRS successfully arguing the captive wasn't really insurance at all. This is the tension at the center of the entire practice. Captive insurance is completely legal, well-established, and used by thousands of companies of every size, but it sits right next to a line the IRS actively polices, And crossing that line has real consequences. So, is captive insurance the secret rich people don't want you to know? Not exactly. It's public information. Anyone can read the tax code, find a captive manager, and start the process. What it actually reveals is something bigger. Insurance isn't just a product you buy to protect yourself from disaster. In the hands of the right structure and the right advisors, it's a financial instrument. One that can move money, manage tax exposure, and transfer risk in ways that have almost nothing to do with a fender bender or a house fire. And captive insurance is just one mechanism the industry doesn't exactly advertise on daytime TV.